Just because you bought a property, that doesn't mean it's a good investment. The numbers are going to tell you everything, but only if you know which numbers to pay attention to. I'm Josh Smith, I'm a realtor and a real estate investor, and in this video, I'm breaking down the core numbers I use when analyzing a deal and what they tell you. Let's start with the most basic, cash flow. This is the monthly profit that you make after your mortgage, your insurance, your property taxes, your property management company, your repairs. Let's say your property brings in $2,000 a month in rental income and your expenses equal $1,600 a month. Your monthly cash flow is $400 a month. But don't just stop there. Cash flow is what makes the property sustainable, but it's not the only number that we need to look at. There's other numbers that show us if this deal is going to be a strong deal or not. Next is cash on cash return. This tells you how hard your money is going to be working for you. Cash on cash return is your annual cash flow divided by the amount of cash you put in. So if you put in $40,000 and you get $4,000 a year in cash flow, that's a 10% cash on cash return. This is a great way to compare between different deals, especially if you're looking at investing in real estate versus another investment vehicle. All right, next is going to be cap rate, and that's one of the first numbers that investors ask about when they're analyzing a deal, and for good reason too. Your cap rate gives you a quick snapshot of how much income a property is going to generate before you factor in financing. Let's say you're looking at two homes, one in a high-yield neighborhood with the lower purchase price, another in a competitive suburb with a higher price but more potential to appreciate. The first might show a cap rate of 8.5%. The second might show closer to 5.5%. That doesn't mean the first property is better, not necessarily. Cap rate tells you cash flow, not risk, and it doesn't include things like how fast the neighborhood is growing or how likely you are to find stable tenants in the area. I always tell new investors to use cap rate as a starting point, but not as the only number that they look for. Now let's talk about appreciation and equity building. These are your long-term wealth builders. Over time, your property may increase in value and each mortgage payment increases your equity. You don't see these gains monthly, but when it's time to refinance or sell, that's when the wealth shows up for you. Next is going to be the break-even test. I always ask, if this property doesn't appreciate, will it still cash flow? If the answer is yes, that's probably going to be a safer deal. If you're banking on appreciation, you're speculating. But if you buy for cash flow, appreciation becomes a bonus. Eventually, you want to look at the total return, cash flow, appreciation, principal paydown, tax benefits through depreciation. That's the full picture, and that's how real estate quietly builds wealth. So if you're interested in investing or you're already looking at deals and not really sure how to run the numbers, let's talk. I work with investors every day and I can help you make sense of the numbers. Reach out or check out the investor page on my website to get started.